Hello and welcome to the second video of Chapter 6, The Role of Accounting in Business. We're going to move in this section to look at some of the other financial statements, starting with the balance sheet. What we just reviewed was what's called the income statement, which shows the sales and expenses of an organization and whether a profit is made. So the balance sheet indicates what is the assets and liabilities of a particular company. So to understand greater what a balance sheet is, the balance sheet tells you what you have and where it came from. And what's different about this financial statement is that it's at a specific point in time. It's not over a period of time like your income statement was. It's at a specific point in time. If you pull up your account at a local bank on your iPhone and you look at it and it says you have $3,242, that's what you have at a specific point in time. It's not over a period of time, but at the point you're looking at it on your phone. There are three sections or three key pieces of information on a balance sheet. Assets, which is what is of value to the business, what we call business resources. Liabilities, which are debts that are owed to somebody. And then the owner's equity, or the amount that the owner has invested in the business. In all balance sheets, assets equal liabilities plus owner's equity. So when you look at a balance sheet, if it's done properly, your asset section will always equal your liabilities and owner equity sections. So here's a simple balance sheet. Your assets, again, things that are of value to a company, in this case cash, is $600. Liabilities, which are what is owed to somebody, is $400. And the amount that the owner has invested in the company, what we call owner's equity, is $200. As you can see, assets equal liabilities plus owner's equity. We're going to look at two other financial statements that help us determine the balance sheet. They're not as important for this class as what the income statement and balance sheet are, but they're important to know what they are. And the statement of owner's equity tells you where the equity came from over a period of time, and the statement of cash flows shows how much cash comes in and out of a particular company. So here is a statement of owner's equity. It is as of September 30th. As of September 1st, we had $200 worth of equity. We made $100 during the month of September. That income is left in the business, and so $100 is shown here. And so at the beginning of the month, the owner had invested $200. By the end of the month, the equity had increased to $300. So the statement of cash flow tells us where did the cash come from. And it can come from one of three areas. It can come from running the business. It can come from investing money that we have in the business. Or it can come from people we borrow the money from, meaning we got financing somewhere. And so we want to understand which of these areas is providing the cash that the company has. And so it's important to understand the difference between what's called cash accounting and accrual accounting. Cash accounting is recording everything when the cash comes in or when the cash comes out. And that is only done for probably the very smallest of little businesses. Accrual accounting records the transaction when it happens, regardless if the cash comes in or the cash goes out. So for example, if a customer buys something and we give them till the end of the month to pay their bill, okay, now what we have is accounts receivable. A sale of $1,000, no cash came in. At the end of the month, the customer agrees to pay that bill. And so to record that, we record an accounts receivable. This accounts receivable is an asset The reason being, it's something of value to our company. If the company buys something and the company they buy it from says it's okay to pay later, then we create what's called an accounts payable because we're paying that money later. This happens to be a liability because it's something we owe to somebody. And then if we buy or manufacture goods and we put them on the shelf, we don't have any money coming in or going out. And so we then have inventory. And so we put it on the shelf. We record this as an asset. Why? Because again, it's something of value to our company. So here are some examples of a little more detailed financial statements. So before we had real simple income statement, here's a little more detailed income statement. This happens to be for the year ended. Remember, we talked about that it's always over a period of time. And so for the end of the year, so the year ended in December 31st, 2000, let's say 16, this is the income statement for the whole year. 500,000 of sales, 275,000 worth of cost of goods sold for a gross profit of 225,000. We then have all these operating expenses. Again, you can see it's much more detailed and broken out than the simple one we looked at last time. So we have a total operating expense of 175,000. We had income before interest and taxes. We had interest expense that we owed the bank. We had taxes that we owed the government. And so our net income is $30,000 on sales of $500,000. If you look, we have the exact same sections we had earlier. Sales, cost of goods sold, gross profit, operating expenses or expenses in general, and net income. Balance sheets are normally broken into two sections of current and long-term. So assets are current, those that we can change into cash in a year, and those that we have for more than a year. And the same is true with our liabilities, those that are due within the year, and long-term, those that are due in more than a year. So this balance sheet here, again, as of a specific date and time, had assets of cash and inventory, and long-term assets of furniture and displays and equipment. And so our total assets were $275,000. We had some liabilities that we owe this year, current or short-term liabilities. Those that are long-term, it's still a liability. We still owe that. We just don't owe it this year. And then the owner's equity, the amount the owner has invested in the company. Assets, $275,000. Liabilities plus owner's equity, $275,000. Here's the statement of owner's equity starting at the beginning of the year. We made money, so that equity is put into the company, or basically stays in the company. And at the end of the year, now our owner's equity has gone up from $150,000 to $180,000. Here's a balance sheet that has a little bit more detail than the ones we've looked at. Cash, accounts receivable, inventory. Again, these are assets. These are things of value to the company. Long-term assets, furniture and equipment. So our total long-term assets are $120,000. Accumulated depreciation is a lot more detailed than what we need to get into, but it's taking into consideration that some of the assets that we have start to wear out and become less and less valuable over time, and that's what depreciation does. So we have total assets of $360,000, liabilities, owner's equity, again, the two equal at $360,000. Here's what's called a statement of cash flow. And again, I would like you to understand income statements well, balance sheets well, and be aware that a cash flow statement and owner's equity, what they do and the purpose of them, but we don't need to understand them for the purpose of this class like we do the first two. So cash, we have $45,000 worth of cash based on our activities, our operation. We had cash outflows because of financing. We owed money on loans. And so our increase in cash during the year is $20,000. Again, it's important for us to know that as of December 31st, this is where our money came from. Here's what's called a comparative income statement. And so we look at it for this year versus last year. Sales went up, $600,000 this year, $500,000 last year. Cost of goods went up. That makes sense. Why? Because we're selling more product. Operating expenses went up a little, and so our operating income actually decreased. We made $100,000 more in sales, but we had less income for various reasons. Less our interest and our taxes. And so even though we sold $100,000 more of merchandise, we made less money. Here it's done by percentages to help us understand why. So the exact same numbers in 17 and 18, and we can see here that our cost of goods sold is what increased dramatically. At last year was 55% of our sales. This year it's 64% of our sales. That's probably the biggest contributor to the fact that even though we sold $100,000 more, we made less money. Here's a comparative balance sheet. Same type of purpose to understand how things look this year versus how things looked last year. So we have a little more cash, a little more inventory, and a little more accounts receivable. So our assets are up $278. Our long-term assets are down, but our overall assets are up this year versus last year. Then we look at our liabilities and owner's equity. Again, the two numbers match, 368, 368. But we can tell by doing a comparative balance sheet what looks different this year than what looked different or than what it was last year. So that concludes the second portion of our video, looking at the balance sheet as well as the cash flow statement and the owner's equity position.